All right, let's talk about something that sounds complicated but is actually super simple at its core: venture capital math. You know, the stuff that separates the merely good from the absolute best in the business. Let's dive in.
Okay, to really get this, we're gonna start somewhere you probably didn't expect: professional cycling. Think about this for a second. Guys like Tadej Pogačar are setting records that are faster than the champions from the infamous doping era. So how's that even possible? Well, it's not about drugs anymore, it's all about data. They've totally mastered the math, the simple formula of power-to-weight ratios. It lets them perform with insane precision.
So that really makes you wonder, right? If the secret sauce for an elite cyclist is just watts per kilo, what's the equivalent for a venture capitalist? What's that one simple, powerful equation they need to live and breathe to be the best?
And this is where we hit a huge problem. Because honestly, for a lot of the biggest names in venture capital, the math just ain't mathing. We're seeing this trend where these giant firms are raising these absolutely enormous funds, but the numbers they need to hit to get those classic venture-style returns, they're becoming pretty much impossible.
There's a fantastic way to break this down, and it comes from Josh Koppelman. He calls it the Venture Arrogance Score. Love that name. It's basically a simple, kind of brutal reality check. It asks one really direct question. To give your investors the return you promised them, what percentage of the entire startup economy do you need to own? Like, what slice of the whole pie?
All right, let's actually run the numbers so you can see what I mean. Let's take a hypothetical top-tier firm, someone like an Andreessen Horowitz, and say they just raised a monster new fund. We'll call it $20 billion. So that's our starting number, $20 billion. Okay, now for the next piece of the puzzle. Their goal, their target, is to give back 2.5 times that fund to their investors. And you know what? That's actually a pretty standard target. If anything, it's on the low end for what you'd hope for from a venture fund. So you take the $20 billion fund, you take the 2.5x target return, and you plug them into that venture arrogance score. And the result is just mind-blowing. To hit that target, this fund would need to capture 2/3 of all the value created by every single startup in the entire US market. Just let that sink in for a second. Every unicorn, every big exit, every acquisition, they'd need to own a huge piece of basically all of it.
And here's where it all falls apart. Josh Koppelman points out that historically, no single VC firm has ever consistently captured more than 10% of that total value. Not the biggest names, not the legends, nobody. So aiming for 66%? That's not just ambitious, it's basically fantasy. For these mega funds, the math is just broken. Okay, so if the math for the mega funds is totally out of whack, what is the right math? Well, it turns out that all the crazy complexity of venture capital, it really just boils down to two simple, super powerful ideas. And here it is. This is it. This is the watts per kilo for venture capitalists. Ownership plus outliers. That's the whole game. You need to own a big enough slice of a company, and that company needs to be an absolute outlier. A massive home run success. Literally everything else in venture comes back to these two things. Let's see this in action. Picture a fund that gets in early, so they get, on average, about 10% ownership in their companies. Now, most of those companies are going to fail, that's just how it works. But a few big wins. Let's say they still own 5% of a company when it exits for $2 billion. That one deal can help generate an incredible 6.3x return on the entire fund. That's what high ownership in a true outlier looks like. Okay, now watch this. What happens if we only change one thing? Let's say the fund invested in the exact same winning companies, but they got in a little later, paid higher prices, and so they only ended up with a quarter of the ownership, so 1.25% at exit instead of 5%. Look at that difference. The fund goes from a fantastic 6.3x return all the way down to a pretty sad 1.6x. This is why ownership is absolutely everything. And that other half of the equation, the outlier, is just as important. The data couldn't be clearer on this. Venture capital is all about the power law. Over 90% of all returns come from a tiny handful of investments, the ones that return 10x or more. You're not trying to hit singles or doubles here. You are swinging for the fences, looking for that grand slam. Okay, so if we know the magic formula is ownership plus outliers, then which funds are actually set up to pull that off? Let's see what the historical data says about the link between a fund's size and how well it actually performs. And wow, the trend is just, you can't miss it. This data from PitchBook shows that as funds get bigger, the returns, measured by IRR, or internal rate of return, actually go down. The very best performing funds, they are overwhelmingly concentrated in that smaller fund category. It's not even close.
And it's not just about being small, it's also about being new. Get this, over half of the absolute top tier, best performing VCs in the last 10 years were what we call Fund 1s. That means they were run by new emerging managers. You know, people who are hungry, they have something to prove, and they're not trying to solve that impossible math of a giant fund.
And if you need one more data point, here's the kicker. A mind-boggling 91% of the best-performing VC funds over the past decade were under $250 million. The takeaway here is crystal clear. The data screams that if you're looking for top-tier venture returns, you find them in smaller and often newer funds.
All right, so we've established that small funds are in a much better position to get good ownership. But that still leaves the other, trickier part of the equation. How do they find the outliers? Let's check out a really interesting modern case study that's trying to solve this exact problem.
I mean, this is the million-dollar question, isn't it? If you're a small fund and you've got this structural advantage, how do you systematically go out and find those breakout companies? You can't just rely on your old college network or gut feeling. You need a process. So how do you build a machine to find those needles in the haystack? Well, one really cool answer is coming from a firm called D3VC. And instead of playing the old game of traditional networks, they're going all in on a data-first approach. They've managed to build this proprietary, exclusive data set of over 8,000 companies from the investment crowdfunding market. And now they're using AI and machine learning to predict which of those are going to get follow-on funding from later-stage VCs. So here's how their method actually works. They start with this massive pile of data. Then, their machine learning models sift through it all to predict which companies are most likely to get that crucial follow-on funding. And finally, they don't just bet on a few. They build a really diversified portfolio of around 200 small investments. It's all about maximizing their chances of hitting one of those true outliers. Okay, let's pull all these threads together. The fundamental math of venture capital, that simple formula of ownership plus outliers, that's timeless. That's not going to change. But the tools we're using to solve that equation, they're changing in a huge way. And this new data-driven model is really starting to turn heads. You can see it in what one of their investors, Patrick Manasco, says. He points out that it's that unique combination of an exclusive data set and really sophisticated machine learning that's opening up a whole new way to find these amazing early-stage companies before the rest of the market even knows they exist. And all of this really leaves us with one big, fascinating question for the future. As we move forward, what's going to win? What will be the driving force in finding the next Airbnb, the next Stripe? Will it be the old school venture model, built on human intuition and who you know? Or will it be these new data-driven approaches powered by machine learning? The answer to that is probably going to shape the entire future of innovation. Thanks for tuning in.